December creates the perfect environment for short squeeze setups. Low liquidity, holiday trading hours, shrinking volume, and year-end positioning make it easier for short sellers to get trapped and harder for them to escape. The first major signal of a December squeeze is high short interest combined with high utilization and rising borrow fees. The second signal is a low float paired with declining daily volume, which increases the impact of even small buying pressure. The third signal is unusual call flow, sudden out-of-the-money call buying, repeated sweeps, or rising premiums at the ask. Options give traders a safe, controlled way to play these explosive setups. Debit call spreads are the most disciplined approach. Small-sized OTM calls are high risk, but can capture extreme moves. Gamma ramp setups occur when market makers must hedge heavy call buying, accelerating the squeeze. The most important part of trading squeezes is the exit. These moves end faster than they begin. Take profits into strength, scale out at clear momentum peaks, and avoid holding overnight unless you're prepared for the risk. December looks quiet, but it's one of the best months of the year for under-the-radar squeeze opportunities. Thanks for joining us at optionstrading.org.